We didn't want to necessarily be landlords. We didn't want to deploy large sums of capital at once into one deal. We wanted diversification. We wanted access to institutional investments as opposed to smaller projects that were affordable for us with the amount of money that we had in the bank. And we also weren't accredited investors. So we didn't have any of those things going for us. And we really wanted to be able to passively deploy our capital, but didn't know where to do so as an average Joe out in the market.
Hello, everyone. Rick Albert here with another episode of The Key to the City of Angels. I'm super excited because we're going to talk about a different way to invest in real estate. I have Mor Milo here of Relli. Thank you so much for coming on.
Great to be on, Rick. Thanks for the invite.
Yeah, so let's start with your background and what Relli does, and that'll allow us to go into the conversations so we all know what's going on. So why don't you start us off?
Sure. Relli is attempting to create a stock market for real estate where you will be able to invest and trade in real estate backed securities as easily as you buy stock on the stock market or trade different securities on your Robinhood account, your E-Trade account, or any of the other brokerage firms that exist in the marketplace. And the reason why we built it was really because me and my business partner, Ross Steiner have been building businesses for the last 10 years or so. And we had access to stocks and did really well in stocks over a period of 10 years or so. And we wanted to do the same thing, but for real estate. We wanted to get into real estate. We didn't want to necessarily be landlords. We didn't want to deploy large sums of capital at once into one deal. We wanted diversification. We wanted access to institutional investments as opposed to smaller projects that were affordable for us with the amount of money that we had in the bank. And we also weren't accredited investors. So we didn't have any of those things going for us. And we really wanted to be able to passively deploy our capital, but didn't know where to do so as an average Joe out in the market. And what we discovered was that there was this whole industry behind closed doors of private placement deals that people invest in and syndicate capital into. And the wealthy and the large institutions of the world have been investing in this way for many decades. And we wanted to facilitate that industry shifting into the mass market and allowing for average Joes like us to deploy $100, $1,000, $10,000 at a time into these deals that normally required $25,000 to $200,000 minimum, and for you to be what's called an accredited investor, which we'll get into in a little bit. And essentially, what we ended up doing was building our first product, going out to market about 3 years ago, and communicating with over 100 to 150 sponsors, real estate development firms that raise capital from retail investors, and gauging their interest in going out to the mass market. And the response that we got from them was, we'd love to do this and show us how to create and cultivate relationships with retail investors that are accredited or qualify from a financial perspective. And the qualification, just for context, is $1 million in assets or $200,000 in income as an individual or $300,000 with a spouse. So a small subsect of the market. And through that process, we've been able to build this marketplace where we have brought these deals that have, for the most part, been behind closed doors to the public, such that everybody can now view them and connect with these real estate sponsors if they qualify and deploy their capital. And slowly but surely, what we're seeing in the marketplace is that more of these real estate developers are taking advantages of opportunities to get out into the mass market by leveraging crowdfunding syndications that were originally meant for venture capital, that are now being leveraged by real estate development firms and lenders to go out and solicit opportunities to average consumers and retail investors. So we've built a cool little marketplace where people can check out deals and find 8 to 25% returns annually on real estate backed investment opportunities that also provide tax benefits and consistent cash flows throughout the year. And it's been quite a journey, but we're starting to really get a little bit of steam, and we're starting to slowly but surely grow our audience and grow our customer base. And there's only better and a greater number of deals that we have available for our investors.
It's interesting because when people talk about California and, why aren't people like developing in California? Part of the problem is the money. But I think the money's out there, right? And that's what you're proving. It's like the money's out there. It's just a matter of doing that connection.
What I would say is this. I would say that the Los Angeles market specifically, if we talk about the City of Angels, is a very unique geographic marketplace that if you don't understand how to deal with the city and how to properly underwrite your deals and what is going to go into actually building that property from where it is today to where it needs to be to meet certain codes or just to get it to a place where you can consistently rent it out and have some form of cash flow, it's going to be very difficult to walk into that market and be successful. We actually happen to have a deal on our platform right now that's from an operator that's been operating in the Los Angeles market for over 20 years. He's vertically integrated. So what that means is he can literally do everything from acquiring the property to renovating the property to doing ground up construction to he's actually a CPA by trade. But what makes him unique is that he has a deep and thick understanding of Los Angeles and what makes it tick. And I think California and Los Angeles specifically are a very difficult market if you don't do your homework and haven't found the right network of people around you that can direct you properly on what you're actually going to have to do.
It's funny. I know someone, he's a project manager and on the development side. And he was telling me he was being offered like tens of thousands of dollars like per month per project. He's like, you know, the city, the developers will flock to you because you know how to navigate it. I remember when we did our last property myself, like even something as simple as, hey, look, there's more than 3 stairs. I know the city's going to require a handrail. And my contractors, they haven't called it out yet. It's fine. I'm like, but I know it's required. Kid you not, the final inspection, the final walkthrough, the inspectors, you need handrails. I'm like, mother. And we already knew this. But even with LA development, so I don't know if you saw, UCLA came out with a study that we're actually seeing a decline of about 18% per year of building in LA. And they're directly tying it to measured ULA, the mansion tax quotes, because a lot of these developers are building and then the intention is to eventually sell it off. But then there's this transfer tax that's not being hit. So now these developers are losing millions of dollars per transaction. Now the numbers aren't penciling out. So out of curiosity, so when people are investing in some of these projects, is there like an exit? Is that kind of the idea? So then all of a sudden they get their money back and then they can just reinvest into the platform? Or is it just case by case?
Each deal obviously is unique, as you mentioned. And depending on the deal that you're looking at, there is a timeline. And in most scenarios, you're looking at a deal that will have an end date. It will have a closing date. Now, whether that date is disclosed at the beginning or that date is up for determination based off of selling the portfolio or selling the individual piece of property, that's to be determined based off of each individual deal. There are certain circumstances where you have companies that will raise capital into their business and all of the real estate within that business is collateralizing the fund, but that business will continue to move forward. And those deals usually will lean towards a cash flow position where you're going to get a consistent distribution from the revenues being generated within that business, which is a slightly different type of investment from the perspective that it's not tied to an individual piece of property, and the return is based off of what's called a promissory note, which is essentially them promising to pay you back a certain percentage of return based off of the collateralized assets as a whole. But it really depends. Now, in regards to the deals that we have on our platform, we have national deals, so we have deals from all over the country. And some of them will have drawbacks and some of them will have benefits accordingly to where they are in the state. From the perspective of exit, each one of these deals will have some form of preparation for exit that you're going to need to take into consideration, right? If you're going to have a large windfall of capital, you're going to need to position yourself accordingly from a tax perspective, and that would likely require a CPA on your side to set you up to win. But yes, each deal will have an exit of some form.
Got it. And that makes sense. Yeah, because I was wondering about that, because that's what most of these developers do. That way they can pay back their investors and then move on to the next project. So that makes sense. So then I guess over the last few years, when you're talking to some of these developers in terms of raising capital, what has changed? Is it getting that much more complicated to get it? And that's why you guys are stepping in? Is it, oh no, people want to flock to for these projects? Like, how difficult is it now to raise money versus in the past? That's
Yeah,
more the
Rick,
question.
great question. A very astute question. Capital raising has changed in the last 5 to 10 years, mostly because of macroeconomic factors, but also because of the way that investments are being marketed. Well, up until, let's say, the early 20s, capital was pretty free flowing because there
Yeah.
was a limited number of sponsors and capital was very cheap, right? It was
Hmm.
inexpensive. There was a lot of opportunity for large institutions to deploy their capital into equity positions that would generate them double digit returns in comparison to the very nominal returns that they would look at from a lending position. Because of the shift in interest rates, institutions have shifted their energy in a significant way away from equity and towards debt. That's not to say that they're not
Hmm.
deploying into equity, but when you're looking at the risk tolerance of a massive institution with large sums of capital, if they can receive a similar return or maybe a slightly diluted return from a first position lending deal in comparison to an equity position that's at risk, they're likely going to lean towards that first position lending deal the majority of the time. I don't want to put a percentage on it, but a large percentage of the time.
So to clarify, you're saying that they could pay for a property and build everything cash. That's equity position versus accruing or versus leveraging the project. And that's a better deal because they can preserve the cash. Is that kind of what you're saying?
You're very close. Yeah. So think
Okay.
about it
Yeah.
from this perspective. It's so in the financial stack, right? When you buy any sort of property, you're going to have a couple tranches of capital. And to simplify, right, normally if you're purchasing a single family home or a duplex or a fourplex or whatever that might be, you're going to have a lending product that's going to give you, let's say, 80% of the capital that you need. And
Mhm.
then you're going to need to deliver that 20% of equity. Now, in the
Right.
larger deals, the equity position is the same type of percentage, but the number's
Hmm.
big, right?
Sure.
You look at $100 million deal, you're talking about $20 million in cash, right? Not everybody
Right.
can deliver that. Even if you're a big firm that has $100 million in assets, coming up with 20 million cash is not an easy thing.
Right.
So they syndicate that capital and position
Got
that
it.
capital to deploy against that debt that they'll receive. Now, when debt was 3%, 4%, right? There's not a
Easy.
whole lot of margin there. And the
Hmm.
banks are fine taking that money because they have their own methodology around how they create revenues for themselves, and also because
Right.
they can leverage the Fed and do all sorts of fun things. Private institutions, on the other hand, weren't
Hmm.
able to compete because if a private institution collects a bunch of capital, let's say a sovereign wealth fund or a large private equity fund that has a couple $100 million, they need to deploy that capital, but they need to make a
Mm.
return that's more significant than a treasury bond or a
Yeah.
mutual fund. So they had to go look for riskier positions in the equity stack as opposed to the debt stack,
Got it.
right? Now, because debt is 7, 8, 9%, and if you want to look at hard money, you're talking 10, 11, 12, 13, 14, 15%. Now they can take that capital and make those same returns that they were originally looking at in equity, maybe a little bit less, right? Maybe
Hmm.
20%, 30% less, but in a way less risky position. So what that did is now all the operators that were going to these institutions to try to get that $20 million in capital to do that $100 million deal, those guys that were giving them that $20 million in capital are now more interested in the $80 million in debt than they are in the $20 million in equity.
Mm.
So
Got
they
it.
have to go out to find other people that will give them that capital to fit into that 20%. So they have to now go find retail investors. Retail investors are people like me and you that maybe have a little
Hmm.
bit more money in the bank to do whatever they please with, right? Like, I got a couple $1,000,000, I got $5 million, I got $6 million. I want to go put my money out there and do some stuff. I don't really want to touch it. But those people operate based off of emotion and make decisions off of logic, right? So what do I mean by that? If I'm coming to Rick and saying, Rick, I need $5 million, come invest $100,000 of your hard-earned money. Rick's going to say, dude, who's more? Who are you? I don't know
Right.
you. Why should I give you money? I don't even want to look at your deal yet. I don't care what your
Mm.
deal is, right? Because I don't know you.
Hmm.
where the institutions are going to look at the numbers and they're going to negotiate their own deal. The retail investor has to feel connection.
Yeah.
And then from there, they'll say, oh, okay, this deal pays me X percentage. There's a 95% occupancy rate. That's attractive. And they'll use the logic to justify the emotion of connecting with the person in front of them. So what happened is you have a lot of real estate sponsors that were very used to doing the institutional game, which is very logic driven, where an institution can say, okay, you're offering me 18%, I want 25%, and you give me X and take Y, and I'm going to negotiate this. And I don't care about your brand. I don't care about your
Sure.
messaging. I don't care about any of this stuff. All I care about is the numbers. Now they've had to shift their perspective to saying, okay, I need to build relationships with people. So you have a lot of operators that are really great operators that know how to run real estate deals, that know how to manage tenants, that know how to build a financial stack, but they
Hmm.
don't know how to create relationships with people in the marketplace.
Mm.
So that's why we've seen such a crazy shift in the market over the last 5 years from the perspective of syndication. Because what happened was you had a lot of operators that weren't as strong from a real estate perspective, but were great marketers that built relationships and created opportunities for average consumers to feel heard and considered. And they gathered that capital and deployed it, but they weren't great operators. So the deals that they're taking on right now are losing traction. They have stalled distributions. They are losing their money to foreclosure. They can't refinance because they were on floating rates during a time that didn't work. So all of these things are starting to come to play, which makes it even more difficult for the good operators to work back from a bad reputation with retail investors that are a little trauma shook from the last 5 years. So
Yeah.
they need even more help. So that's what we're seeing in the market, is that the institutions are shifting their perspective from equity to debt. And
Right.
the retail investors are shell shocked from the last 5 years, and the operators don't know how to create relationships with them. So all that being said, where Relli happens to find its place in the market is we help fill the gap between the great operators and the work that they've done and communicating it with the retail investors.
Yeah, it's so funny. I've always told people it's like people make decisions based off emotion and then justify it with logic. That's always been the order of operation.
You're
Hey, do you
absolutely
want
right.
financial freedom? I want financial freedom. That sounds amazing. Then you should invest in real estate. Oh my gosh, you're right. And then they're like, oh, no, no, no. Now the numbers make sense. They didn't make sense before, but now they do. But it was interesting because it was all over like the Real Deal and all these other publications where it's, yeah, people who had these massive buildings. But then back in 2020, when they did their last refinance, come the balloon payment, now they're like, what do we do? Especially in LA when there was rent freezes and all these other things, it's we're stuck. So I was actually surprised when you told me that there were still some development happening in LA because they've now announced that rent control is now gotten more strict. Like you can't now the cap's 4% versus before it was up to 8%. Not that it ever was 8% to be on a practical basis, but it was there. If you included utilities, all that kind of stuff. So it'd be interesting to see if some of these developers are going to shift to from building these apartment complexes to maybe switching them over last minute to like condos and just selling them off individually.
It might
And
be interesting. It wouldn't surprise me.
it wouldn't either, right? Because you've already built the infrastructure for the apartment buildings. So there's really not much. And again, I'm not a building code expert, but there's not going to be that much difference in terms of building. And then they're going to be like, look, I can't operate in LA. And then, in theory, now that I think out loud, you avoid the mansion tax, measure ULA, because each unit is going to be sold under the $5 million mark.
And I'll tell you, the what I'm really seeing for the most part is a lot of single family residence
Mhm.
business happening,
Yeah.
and some of the smaller unit counts. Maybe I haven't been approached by too many bigger operators in this state, because
Yeah. I
usually
haven't
they
seen it
have,
much either.
and they operate behind closed doors. Because look, at the end of the day, Los Angeles is a very lucrative market. It's difficult to
Hmm.
operate in it, which because of that, it creates this fenced-in wall of people
Yeah.
that can actually operate.
I
So those
agree.
people are consistent in being able to raise capital for their deals because they're the small but select few of people that have been able to be successful in these areas, right? But yeah, that wouldn't surprise me. There have been a lot of projects that we've seen stall out, but I do see that the current restrictions and regulations in Los Angeles are definitely creating difficulty, let's say.
It's funny. I remember talking to clients and friends, and it's like, yeah, per building code, now they have to add solar panels, and people are like, yeah, that's awesome. And I'm like, is it? Someone has to pay that extra 30 grand,
It's true.
and
It's
it's
true.
not going to be the developer.
It always ends up going into the consumer's pocket, right? It always ends up being pulled right out of the consumer's pocket. And
Yeah.
look, it's with good intention,
Yes.
but it's definitely a difficult market to play in.
Yeah. I don't think the government, I don't know who they're talking to. Because you'd think like someone would bring this up and be like, yeah, in theory, it makes sense, but on paper, I'm not going to lose $30,000. And typically, at least with the solar panel world, I notice developers will either say, hey, like you see a price for $1 million, we're adding, if you can either add on the 30 grand or you can lease it. So the price you see almost never includes the actual cost of the solar panels.
That's interesting. No, I haven't seen that on just because I haven't had too much experience with
Right.
subdivisions being built in Los Angeles, but
Yeah.
that's very interesting.
Yeah, so it's just at least I had a client who bought a townhouse and that was like his options or like some of these newer construction. Now, as you get to the luxury market, it costs 30 grand. It doesn't matter where you build it. It's going to cost you 30 grand no matter what neighborhood. So yeah, you get to the high enough price points, the developers can absorb the cost,
That makes
right?
sense.
Yeah, but you're
No, that
not,
makes total sense.
it's kind of like building in Irvine versus maybe Buena Park,
No, that
right?
makes
Two
sense.
different prices.
100%. And look, it's very interesting. I have a couple home builders in the Los Angeles area that do one specifically that does Malibu homes and does properties here in South Orange County. And he also has to deal with the coastal commissions, which makes things even more
Mm-hmm.
difficult. But thankfully, because of their builds, I think exactly what you just mentioned comes into play from the perspective that absorbing $30,000 to $50,000 into a $10 million home is not a particularly difficult feat.
Exactly.
So, but when you
Yeah.
start looking at a $500,000 to $750,000 house, that makes a big difference.
Exactly, which is why we don't have affordable housing. Because it's like the cost of drywall, plumbing, electrical, whether you're building in Malibu or in Pacoima, the cost of building's practically the same. Recessed lights. I've never heard of a high-end buyer being like, what brand of recessed lights are those?
I,
What kind of drywall is this? Is this high-grade drywall? Let me lick it. No, you don't hear any of that.
no, it's very true. And look, I think what's slowly but surely happening in the world that we live in now is that people are able to leave metropolitan hubs. And I
Mm,
think what is going to be very effective in the next 10 years is going to be operations that are capable of delivering the full eat, play, work experience
very much so.
in new hubs that they can create. But maybe not even hubs, but just creating an interactive city type environment, even in the outskirts, I think is
Yeah.
going to be incredibly effective in the next 10 years because we've just overpopulated certain hubs across the country. And now, with the advent of incredibly fast wireless internet and a virtual workplace, there's
Well,
nothing holding us back, right? There's nothing holding us back from opening it up and shifting away from this archaic model of having to have all the people in one hub battling each other to the last penny. The problem is that there's no alternatives, right? There's no great
mhm.
alternatives. There aren't luxurious alternatives for people to go live in that they can see a reduction in cost of 20 to 50% because they're living on the outskirts. But slowly but surely that's expanding. So I think that's gonna be a trend that we're gonna start seeing in the next 10 years.
Yeah, it was actually on one of my earlier podcast episodes. I interviewed Hana Cha, and she does consulting for people who do the mixed use buildings. So it's the retail at the bottom and apartments on top. So in some ways,
Great
you're
product.
building, oh, I think it's an amazing product. It makes total sense. It's like you're creating that community. So you basically are creating walkability. Yeah, so for a lot of the developers and operators on your platform is a good kind of segue. Where are a lot of these projects happening that
All
are
over the
happening?
country. All over the
Is there any
country. Primary
particular markets that you're seeing more of versus others?
Sunbelt is definitely still very active from a
Yeah,
multifamily perspective. We see a lot of prospective customers that come to us from the Sunbelt, Houston, Dallas, Florida, Georgia, those types of places. We see rather large mix of different types of deals, even up to tertiary markets. Like we have two deals right now in South Dakota that are
interesting.
from incredibly reputable operators with half a billion plus in AU. But yeah, we have everything from primary product. Like we have an operator who's invested in our business that is based out of New York and does high rise in Manhattan. They unfortunately haven't had any great product come to market that they've been able to make pencil in the last couple of years, but that's a
Sure.
trend across the board for most of those primary hubs. We see a lot of Texas,
Yeah,
which is a
it's
good
easier to
place to be
build.
building right now. Good place to
Yeah.
build right now. And we have a variety of deals. So it's not only individual pieces of property, we also have funds on our platform. And those funds can be in investing across the country as well. For example, we have a debt fund that does hard money loans across
Hmm.
the country in single family resident property, in commercial real estate, commercial residential, so like multifamily,
Sure.
in the entire country, right? But you can
Hmm.
invest in a first position lien, or you can invest in the fund as a whole that pays out a 12% annual return on your investment. So we see a little bit of everything, which is really interesting. It gives us an interesting pulse on the market.
That's why I was asking, because it's almost like you get a snapshot, even though maybe not be all the development, you have a better idea of what's happening, but also what's coming up. Because
I
if you know
do.
what projects, it's like it's almost like insider trading at that point. Like people can go on your platform, and be like, where should I invest next? Let's go to Relli and see where all the developments are happening.
I'll tell you, there's thousands and thousands of developments happening at
Sure.
any given moment, right? And
Yeah.
I think the difficulty is figuring out who's good and who's not good and how
Fair.
to underwrite them and then where they all are. But there,
Yeah.
depending on what you're looking for, you can really find anything if you sluice it out hard enough on the
Yeah.
internet. But I think the biggest thing that we bring to the table is education.
Yeah.
We have the ability to educate on passive investments. Most people don't know they exist, and we
Yeah.
have the ability to educate people on who these sponsors are. But yeah, that's the goal. The goal is to come to Relli. You can get whatever deal you want, and you can invest as much or as little as you want into it, and have your own beautiful portfolio that's working for you while you sleep.
Yeah, which is that was a whole perception of like real estate was that it was supposed to be passive because like
And
people are
it's
like,
not.
oh gosh, no. The only thing
So
I tell
not.
people, the only thing that's passive about real estate is your tax return.
Sure.
Like nothing else about this is passive,
Fair.
right? Like people are like, oh no, the landlords are just collecting their checks every month. Like, who do you think is making the calls? Oh, property managers. I'm like, okay, so they just hired out the tasks. If I own a restaurant and have a general manager, does same thing. It's just you're passing it on to someone else to manage. Because I do work with a lot of house hackers and smaller scale investors. Where I guess if you were to create like a criteria, hey, should I be buying my next investment versus investing in one of these syndications? What would be some call it questions that you would have to ask yourself to determine which route to go?
Great. Yeah, I think the first place to start is what's my goal. If your goal is to have 10,000 units,
Hmm.
that replaces your occupation and you are a portfolio manager and that's what you'd like to do, then do that. It's more lucrative and you're going
Yeah,
to have more control over the deals and you're going to have to go through the absolute burden of managing all the properties. And like you said, if you want to hire it out, then remember that takes from your margin. And depending on how levered
very
you
much.
are, your margin could be gone if you hire it out, right? So you're going to have to build it to a place where it's worthwhile to hire it out and then have
Mm-hmm.
the property in a place that could be manageable. So, on the other hand, if your goal is passive income, truly passive, the opportunity would be to go and do some research on how you can deploy your capital in a passive manner that doesn't require you to clean toilets and collect rent and maintain property and fix drywall and do all those things
Yeah.
and start researching what that looks like and looking at all the different types of options and building a portfolio of passive investments.
Yeah.
And I think there's also a balance there, right? If, for example, as an example, we have many operators in the single family residence space that are maybe on the smaller side or the mid-market side that are 5, 10, 15, $20 million in age that are looking for exposure to bigger property in larger metros that they don't have access to. And they
Mm-hmm.
know that if they put their money in those pools, then they're going to start learning about that product, which will give them the opportunity to then go build their own product.
Yeah.
And that's their stepping stone into a new market, which is not a bad way to work as well, depending on
Right.
what your goals are. There are also people that just want to be able to deploy capital into different places and keep on purchasing their duplexes and fourplexes, and they don't want to touch anything in multifamily or retail or self-storage. And they just want to keep on building that portfolio while also having access to those other asset classes. All of them is a great recipe. I
Sure.
think the name of the game is really to get a team around you, get a financial advisor, get a CPA, get a legal team, and have those people with your support and delivery of goals and where you want to go and how involved you want to be. You got to put a plan together
Yeah.
and build it out based off of your background. If multifamily or single family residence better than anybody, and that's where you feel comfortable investing because that's what you know, then you should build a strategy around what it is
Right.
that you know that's most effective for you.
Mm-hmm.
So I really think what it comes down to is getting people around you that have your best interest in mind
Yeah.
and building a holistic strategy for where you want to go and what your goals are. And then from there, you can start to pick and pinpoint operators and asset types to be able to leverage what there's in the market to drive that return for you. But
Yeah.
I think the first place is education and planning.
That makes sense. And I also like the idea of having people around you, because to your point, like if I make emotional decisions and justify it by logic, bring people in who have no skin in the game. I always tell a lot of my clients, I'm like, look, I wear three different hats. I have realtor Rick, friend Rick, and investor Rick. So depending on the situation, ask me which hat I'm wearing, and they're going to be different answers.
100%.
Right?
100%.
Realtor Rick, he just wants to make money and not get sued. He's going to give you that opinion. Investor Rick is like, okay, this neighborhood makes sense. The number of neighbors makes sense. Friend Rick is the guy who's going to deny anything if you ever try to repeat it back to him. And be like, look, off the record, this is like on a practical basis, this is what people have done. Whether it's kosher or not, that's up to them, but there's risk and blah, blah. So yeah, I think you have to decide. And even then, I think it's also your time becomes more valuable and how involved you want to be. Because that was always like my hesitation with like DSTs, Delaware Statutory Trust, REITs. I like having some level of control. And you have to be really comfortable letting that control go.
100%. And you want to know who the person is. You want to know that they have a track record of success. You want to know that you can trust them, that other people trust them, all that sort of good stuff.
Now, do you
And,
guys do that kind of vetting?
oh, of course, yeah, we don't
Okay.
put anybody on the platform that we don't vet through our general counsel and through our CFO. So
Interesting.
I don't
Okay.
actually look at that. I go out and find the sponsors, and then I hand it to my more compliance oriented people that have seen a million of these deals before, and I tell them ask them whether it's good or not. And
Yeah.
we have built an underwriting solution, and slowly but surely is growing and improving. And the goal for us, and we tell all of our investors this: we've checked to make sure that they're kosher. We make sure that they're real people, that they have a real business, that they have a track record, and that we're willing to put them on the platform. That
Yeah.
doesn't mean that you don't do your due diligence. That doesn't mean
Of
that you don't
course.
read the paperwork. That doesn't mean that you don't consult with your financial representative and because everything has risk. These are private deals with private people, and you have to understand what the risk profile is before deploying your capital. Just like
Right.
how in the stock market, you can go and buy futures and do all sorts of crazy derivative type trading.
Right.
Would someone recommend that to you? Probably not. But do people make a boatload of money doing it if they know what they're doing and know what they're looking at? Absolutely. People make
Yeah.
insane amounts of money doing that. So it's one of those things where the first move is to get educated. The second move is to get smarter people around you. The third move is to bring all those people together and actually like dig into the details and the data. And then I think the fourth move is to understand the risk and be comfortable with the risk before deploying your capital.
Is there and again, everybody's different, but from people you've talked to, and maybe I should bring a financial advisor, maybe the three of us could chat about this. If
Sure.
a certain percentage, because you have to be comfortable with it, you have to be also comfortable with it being gone. That was always like my big fear with the stock market is I could invest in Home Depot, But what if Home Depot does something stupid? The
You never
money's
know.
gone.
You're
If a
right.
house burns down, I at least have an insurance policy on it. It's in a lot of ways, it's much safer.
Look,
More
it's 100%. It's one of those things where you have 100% of the control in
right,
purchasing the house.
right.
No question
But
about it.
but you probably in some ways might have less risk with some of these syndications
I
because
wouldn't
you,
necessarily say that.
well,
Look, is it
in the
possible
sense
that
of they may have a better understanding than you do. If I buy a fourplex, but I screw up somewhere, that an operator would never have screwed up on.
that's true? That's true. Look, there's no doubt that they are professionals and they've been around the
Right,
block, and these people have made a living out of creating that type of solution for investors. And what we believe is that it's likely better in their hands than it is in our hands, from the
right.
perspective that we've we haven't done a 268 unit multi, but these
Exactly.
guys have. They have 21 exits and 26 years of experience, and that is comforting and accurate from the
Right.
perspective that they know what they're doing at a higher level because they've been through it and they've done it. It's not to say that the risk profile is
Sure.
lower, because no matter which way you slice or dice it, the risk is still there,
Yep.
right? The risk profile doesn't change because of who the operator is. The operator can reduce the risk of the construction of the property or bring their knowledge and experience to the table, but it doesn't mean that we negate the risk in any way, shape,
Yeah.
or form. So I think from that perspective, it could be comforting to have someone on your team that you invested in that has that experience. And you definitely have more control and more ability to make decisions when you have your name on the deed.
Yeah.
I wouldn't necessarily compare the risk. I would say probably
It's trade-offs.
trade-offs. It really depends on who
Yeah.
you are, right?
Yeah.
Because if you've done 100 flips, then you maybe
Hmm.
have a better chance than putting your money with a syndicator that you have never read a PPM. It's your first time looking through a private placement memorandum and looking at all the numbers and doing the splits and doing the math. You might have a better solution there if you've done 100 flips or even 50 flips, right?
Yeah.
If you're going out to the market for the first time and you're a software developer at eBay and you make $1 million a year, does it really make sense for you to take the opportunity cost of learning how to do this flip right now? Maybe not. So I think it really depends on who you are. And that's where we were talking about from a financial advisor perspective, right?
Right.
Bring in that team and say, okay, this is my know-how, this is my knowledge, this is where I'm at, this is what's available to me, this is what we can do. What are the benefits and the drawbacks of each direction? How can I make the best decision?
Sorry, one second. My daughter just decided to pop in.
Oh, hello.
Hello.
What's her
You
name?
want to say hi?
Hi,
Hi. Oh,
Hi.
you're so sweet. Hello.
We're
What's
talking
your
real
name?
estate. What's your name?
Audrey.
That's right. It's Audrey.
Audrey. Oh,
That's
it's
right.
beautiful, Audrey. Nice to meet
Yeah.
you.
Sassy but classy.
Sassy but classy. I love
All right.
that.
Go to Mama because we have to finish up our conversation. I would tell you all about it, but you still have a few years. Okay?
There'll be plenty of time, Audrey. Don't you worry.
Oh, yeah.
Okay, Mama.
Okay. Say bye.
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 All right. Go to Mom. Sorry about that.
No worries. That's awesome.
Yeah. No, I told my wife, I made it really clear when she gets to a certain age, she's actually going to start helping with the properties. And if she
I
does
think
not
it's
help, she does not get them. We'll donate the
oh
properties if we drop dead.
wow. No, that's strong. I like that. But no, it's a
Yeah.
good thing, man. So my background actually, my parents came to this country when I was 4 months old from Israel. And my parents lived a very frugal life, and what they did was they bought real estate. So
Mhm.
I firsthand watched them do the single family residence, be a landlord thing for the last 30 years. Excuse me. And yeah, that was the exposure that got me to a place where I was like, ooh, I do really well in stocks. I should probably have that same type of experience because I don't want to deal with Section 8 housing and kicking out tenants and evictions and the
Thing.
property it's a thing, man. It's part of the game.
I've had to do a few evictions out of state, and people get super scared. I'm like, look, if you own a property long enough, you're going to do an eviction. It's
Part of the game.
just is what it is.
Part of the game.
If you haven't done an eviction, if you haven't had tenant turnover, whatever, then you either don't own enough properties or you haven't been in it long enough. We just sold our last LA rental. I had a couple properties in LA that would house hack my way through. So bought the condo, rented out the second bedroom, then it became a full-time rental. House with ADU, my wife and I lived in one unit, rented out the other, and then eventually swapped. But part of the reason why we sold was like, look, we've been investing in LA for a decade, and knock on wood, we haven't had all the horror stories that you hear about LA. So we're like, why don't we end this on a high note?
Not
Because
a bad
again,
decision.
You hold on to a property long enough, a tenant's going to be like, look, I'm going to stop paying and I get free legal services. So do you want to go down this path? So we're like, let's just take that off the table.
Yeah, that's a bold move, and I think probably a smart move. Look, I'll tell you,
we'll find out.
We always do.
Right?
It's a tough thing because, for example, our single family residence flip and rental guy that's on the platform, his name is Pavan Madi, and Pavan is all about the equity. He doesn't play the cash flow game. He's playing a long game. So all the money gets reinvested and reinvested and reinvested, which is a beautiful thing. It takes a certain type of person to have that type of patience and to deal with the level of pain with the compliance. The opportunity, though, from an equity growth perspective, is very lucrative. And that's the trade-off, right? And that's the game that you play. You play the game of, okay, if I know that I'm going to have to reinvest my earnings back into making sure that things are up to code, taking care of legal, taking care of tenant management, taking care of whatever reserves I need in place to make sure that if a tenant doesn't pay me, I don't have the ability to collect for the next X number of months, that I still have the long-term perspectives from an equity position of growth and significant growth. And it is there, but you have to attack it from that perspective. You have to come from an understanding of what the game is here. And it's very unique to Los Angeles.
It is. And one of the things I've told clients is that, look, the more complicated it is, more people leave the market. You're the only game in town. What tenants don't realize is the more laws that come into place, the more it actually hurts them.
Totally.
I've tried to explain it to people and they don't get it. I'm like, you don't understand. We're short housing. Yeah, we're short housing. I'm like, how do I explain to a developer they should build in a market where where you're capped on the rents? Tell me, how do I convince them when they can literally go to Orange County, Riverside, Ventura? They can use the same crews and drive 2 hours out of their way, have the same appreciation and all that, and they don't have to deal with it. But no, people are like, oh, landlords are greedy. I'm like, you don't go to work for free.
Beyond the landlords agree, the landlords are the people that are keeping the lights on and the doors
right.
You need them. Although they're making big bucks, that's because they took big risk and they deliver big rewards to a lot of people. So
I agree.
There's a balancing act with everything. I feel people don't like to look at the other side of the balance, and they don't remember, hey, without this infrastructure, without this housing, you know what happens? Less supply, more demand, more expensive. Rent stabilized, there's no more product going into place. So maybe there's going to be a small percentage of rent stabilized property in Section 8 and all that sort of fun stuff, but not everybody's going to qualify for it. And who else isn't going to? It's just.
And then you have the people on your platform, right? Because then that's where the institutional investors are like, look, we can have the attorneys on staff. So if a tenant wants to play games, let's play. It's not going to cost them any more to play the game versus a mom and pop.
Yeah, if you're prepared, and that's why the big groups are doing well and the smaller groups struggle in this market. Like big market is very tough, but institutional level asset managers and sponsors do well in this market because they have. It's the conversation around regulation. Why do the big businesses want more regulation? The conversation is because it removes the small guy, removes the middle of the market because they can't afford to do business. But that's a business owner's mindset, right? You have to be in a position of understanding how the finances actually work and how all this stuff affects one another for it to make sense. If you're an average consumer that is maybe a skill worker, a very intelligent person in some form of trade, that's great, but maybe you don't understand the macro and microeconomics that are affecting your community. But those are the things that are affecting every single person in the market because
Yeah.
of the way that the regulations affect building infrastructure.
So if someone wants to take the risk off the table but still invest in these high cost markets, that kind of is where you guys come in.
Yeah,
It's a
I'd
way
say
for
so.
it's a
I'd
way
say
for
so.
someone to jump into it.
Yeah, and I think more even take it a step further. People have been promising passive
Yeah.
income for a very long time,
Yeah.
and what I think we've sold the average consumer is that if you go buy a rental property, it's passive income. It's not. It's very
Right.
active income. You have to work for it. And that's not to say that the passive income doesn't exist. It does exist.
Sure.
The thing is that it's not available to the market. So we're trying to bring it to the market and we're trying to give people options. And yes, I think that it could de-risk if you don't know anything about building real estate, but you still want access to the real estate market, or even
Yeah.
if you're very focused on one type of real estate, like single-family residential, and you want access to the bigger game, then what we definitely do is give you access to highly qualified operators that can give you that access 100% passively.
Yeah. Okay. Perfect. And I totally agree. All right, Mor.
Thank
Thank
you.
you so much. Yeah. Thank you so much for coming on the show. How can people get a hold of you?
You can check us out at relli.co, so relli.co. We are on all social platforms at Invest with Relli.
Okay.
And you can check me out personally on LinkedIn. I'm very active on LinkedIn. My first name is Mor. My last name is Milo. If you look me up, you'll find me.
Perfect. All right. Thank you so much for coming on. And everyone, thank you for watching or listening. And I'll talk to you guys next week. Want to keep unlocking the secrets to building real wealth?